Well, good morning, everybody. We're going to start something different now. Instead of me doing a live Zoom session on Tuesdays and Thursdays, I'm going to just do a live Zoom session on Tuesday, or the first time we start a new chapter. And instead of doing the lecture in the live portion, I've made these videos that you can review. And the one session that we'll have a week is just kind of running problems and giving you an overall picture of what we're doing. So I'd like to start now with chapter 7. So I'm going to get my iPad ready. Go ahead and share my screen. Okay, so this is the handout that I wanted you to print out. And this handout covers chapters 7, 8, and 9. So what we're going to do is use this one handout for the next 3 weeks. And today I'm just going to go over chapter 7 with you. Okay, the first problem is about credit cards. When your customer uses a credit card, well, when you think of a credit card from our point of view as a business, when your customer uses it, it's really like a cash sale. And you think of it as a cash sale, right? Because what happens is, they give you the card and you process it, and you'll get money back from the credit card company. But now they're not going to give you the full amount, right? They're going to take the sales plus the tax. In this case, there's no tax, but the sale, and then they're going to hold their portion. And so they may charge you like $3 of the sales. They'll hold that back, and that's how they make their money, and you'll get the rest. So let's go ahead and look at number 1. Sold $30,000 of merchandise on a Visa card. Visa charges a 3% fee. The net amount was immediately deposited in the seller's account. Journalize the transaction. Okay, well, we sold merchandise for $30,000, so we're recognizing sales of $30,000. Okay, now, because they used a Visa card, Visa is going to charge you 3%. And so what they're going to do is they're going to pay you actually 97% of it, right? Because they're going to charge you 3%. So that's where we have a debit to credit card expense of $900. The sales of $30,000 times 3% is $900. They're going to hold that back, and they're going to give you the $29,100. And you wonder, well, why should we do this if we earned a $30,000 sale and we're only going to get 97% of it, right? The $29,100. Well, it's because your customers are apt to buy more from you, because if you start pulling out those greenbacks, they're going, oh man, it hurts. But hey, plastic in the hand, money in the bank. So you are willing to accept the credit card, but you just got to know that Visa, these credit card companies, are going to charge you like a certain amount, usually like 3%, right? So sales of $3,000, they're going to hold back $900, which is to us as a business, it's credit card expense, and they'll give you the balance. Okay. All right. The greater majority of chapter 7 is on accounts receivable and notes receivable. And so, anytime that we extend credit to our customers, we know that some customers are going to stiff us money, right? So we're going to have bad debts. And in time, we're going to write off their accounts receivable because we're not going to collect. So, matter of fact, I guess it's good that you extend credit because you're going to make more money, and you're going to get more receivables and more cash eventually. And as long as you're, the people that stiff you are less than the customers that do pay you, you're okay. But anyway, we use what's called the allowance method to estimate bad debts, right? So, matter of fact, I'm going to show you how we do this. Stop the share. Oh, didn't really have to do that, did I? But that's okay. Well, maybe I did. Yeah. Let's do this. Share screen one. Okay, so this is in the video presentation. It's in the PowerPoint, but I just want to bring a couple of slides up so you kind of have a framework of what we're doing. Okay, so when we sell on account and we have accounts receivable, we know that some of our customers are going to stiff us money. So there's deadbeats in this amount. So we can't really say, hey, we have the asset $500. We know from experience that that's not the case, that we need to write down the receivables to net realizable value. So let's say that of this 500, we think that $25 worth are going to go bad. And so we're going to write that down by this contra asset account called allowance for doubtful accounts. It's kind of like truck less accumulated depreciation is book value, right? Because, accumulated depreciation is a contra asset account related to like the truck. Here, the allowance for doubtful accounts is the contra account to the accounts receivable. But that's how we write it down so that the readers of the financial statement knows, okay, we have $500 of receivables, but we are only going to be able to collect $475. Now, we use the allowance method because in the allowance method, we estimate ahead of time how much we think are going to be written off, right? We know, well, we think that 3% of our credit sales are going to go bad. Okay, so we'll find out what that number is, and then we'll have this adjusting journal entry. And it's always this way: debit bad debt expense, credit allowance for doubtful accounts. Okay. So that's what we're going to do in the first one. So let's go ahead and stop the share. Go back to this. Okay, so King Corporation uses the allowance method to estimate bad debts. Well, you say to yourself, well, why would you estimate it? Why don't you just wait until we know who they are? Well, the thing is, it's matching of revenues and expenses. And when you listen to the videos, you'll see that. And when you read the book, you'll understand that. But basically, we know before it even happens that when we give credit sales, some people are going to stiff us. So we estimate that ahead of time. So we actually match the bad debt expense against the credit sale in the same period. If we wait until when it actually happens, the credit sale could be in January and the write-off of that receivable could be in March. So it's a disconnect. So what we do is we try to match revenues expenses by estimating. And like I say, the journal entry is always the same. Debit, bad debt expense, credit, allowance for doubtful accounts. So that is the entry that you're going to need. Now, let's say that, that we have, in this example, accounts receivable of 190, and we think that 20 are going to stiff us. Well, we may just go bad debt expense 20 and credit allowance for doubtful accounts 20, right? Because we want to get that 190 down to 170. Now, I will tell you that there are different methods of doing that, of coming up with this number. So we'll talk about that just a little bit, okay? So let's go back. I'm going to go back to my PowerPoint here. Okay. And I'm going to keep going here. I'm going to go to 31. I like this one. Okay. So this slide really tells you, like what's really kind of going on. Okay. So let's just talk this through and then we'll do the problem. We right now have accounts receivable of 500, right? But we estimate that of that 500, there's $25 that are going to be uncollectible. People are going to stiff us about $25 of this. So what we'll do is, because it's an estimate, nobody's really stiffed us yet, but we just kind of estimate it from past experience. So we're going to debit bad debt expense 25, credit allowance for doubtful accounts 25. So now that bad debt expense goes to the income statement, right? Because expense is income statement. And this allowance for doubtful accounts it goes in the balance sheet as a contra asset account to accounts receivable. So look what happens when we do this entry. Here, we're going to put that 25 in because, right, we did this entry, credit allowance for doubtful accounts, 25. So there it is. And it's reducing our receivables to net realizable value. Now, this is really kind of interesting because let's say that later, one of our customers stiffs us money. And guess who it is? It's I'm a flake. I know you got to think that's pretty good. That's about the best I can come up this morning. I'm a flake. Okay, now you have to know that IMA is part of the $500, right, of accounts receivable. And IMA is also part of this write-off. We estimated that she is in here, although we didn't know it's her, but we estimated it. So when we actually write it off, look what happens. Now, this is the journal entry, and it never changes, so just memorize it. Debit, allowance for doubtful accounts, and credit accounts receivable. So you're taking out the receivable, which makes sense, you're writing it off, but also you're taking IMA's part of the allowance, right? Because we estimated that somebody's going to go bad and IMA's part of that. So now we take it out. But look at the effect on net realizable value when we do this. When we write off, we're going to be debiting accounts, allowance for doubtful accounts. So notice that that's going to, reduce the amount of the allowance. That's good. And of course, we're reducing our accounts receivable by credit. So that's going to reduce our receivable. So what's the net effect after the write-off? What's going to be our net realizable value? It's the same. Well, and you say, well, how could that be? Because, we're writing off IMA. Remember, net realizable value is the same because the deadbeat was already written off, right? The IMA was here with the $500 and IMA was put in here. We estimated 25. We didn't know it was I'm a flake, but nevertheless, she's there. So when we write her off, we're not only writing off her accounts receivable, we're writing off a portion of that allowance for doubtful accounts, right? So anyway, net realizable value is the same. Okay. So the punchline here is when you write off an account, you're going to be debiting allowance for doubtful accounts and crediting accounts receivable. Okay. So let's go back to our iPad. Okay, so number 3, Taylor Company uses the allowance method to account for uncollectibles. On October 31, it wrote off a $1,200 account of a customer, Gary Freeman, journalize the transaction. And here, I just wanted you to know that when you, in the allowance method, when you write somebody off, you write off the receivable and also his part of the allowance for doubtful accounts. So debit, allowance for doubtful accounts, $1,200, credit, accounts receivable, $1,200. So these are the 2 entries that you really need to remember, and they don't change. You know, when you make the estimate, and that's what it is, it's kind of like estimating depreciation, right? Same thing. We're estimating the bad debt expense. So debit bad debt expense, credit allowance for doubtful accounts. And also when that's the estimate. And then when you actually write a customer off, it's debit allowance for doubtful accounts, credit accounts receivable. Okay, now what happens if you wrote off Gary Freeman and he's racked with guilt? He said, I can't believe it. I'm a good person. I pay my bills. So he actually out of the blue comes back and said, hey, here's your money. I want to pay what I owe you. Well, man, you already written them off, right? So what do? You have to reinstate them. So when somebody pays on an account that you've already written off, it's a 2-step process. You have to reinstate the receivable and then receive the cash against the receivable. Okay, so this reinstatement, well, it's just basically flipping the journal entry, right? It's flipping the journal entry. So here, when we wrote off Freeman, debit, allowance for doubtful accounts, credit, accounts receivable. Now, but since he's paying us, we have to flip it and put Freeman back. So here we credited Freeman. Now we're going to debit Freeman and put his allowance for doubtful accounts in. Now, once he's there, now you have accounts receivable to receive the cash against. So then you debit cash and credit the accounts receivable, and you're done. So it's a 2-step process. Okay. All right. Okay. Okay, this is another slide, and it's kind of interesting. You see this woman DJ, and you're wondering, well, what's that have to do with accounting? Absolutely nothing. I just thought it'd be something to catch your attention. So I guess it's working. All right. So when we make the estimate, we debit bad debt expense and we credit the allowance for doubtful accounts. There are 2 methods that you can use. And what I like about this slide is I even tell you to write it down, this information, because it's all right here. You use the percentage of sales method or the percentage of receivables method. So in each case, you're going to take the sales, credit sales, and multiply it by 1%. And in the percentage of receivables, you're going to take accounts receivable and multiply it by 1%. Easy peasy, right? Now, this one's the easiest one. And let me tell you why. You don't have to consider the balance in the allowance. Say what, Tetra? Yeah, I was thinking about writing a rap song, balance in the allowance. Dum, 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 I don't know. But anyway, in the percentage, I'm going crazy, aren't I? In the percentage of receivables method, you have to consider the balance in the allowance. So just remember that. You don't even know what that means, but I'm going to tell you what that means right now. The only one that you have to consider the balance in the allowance is the percent of receivables method, right? Okay, so let's go ahead and I'm going to do that with you. Matter of fact, should I keep going here? Now I'm going to wait. I'm going to stop here and use my iPad again. Then I'll go back. This one's pretty easy peasy here. I like this one. Okay. Here's some information, and we're going to use the same information for the percent of sales and also the percent of receivables method. Now, I say this percent of sales method is really easy because you're just going to take your net sales and multiply it by 1%. Okay, let's read what I say here. Assume your company uses the percent of sales method. Your company estimates that 2% of sales are uncollectible. What is the adjusting entry to record bad debt expense? So we're just doing an estimate here. So remember, the estimate to record bad debt expense never changes. Debit bad debt expense, credit allowance for doubtful accounts. Okay, well, how do we get the number? Well, it's simply the net sales of 350,000 times the 2% that we think they're going to go bad. So 350,000 times 2% is 7,000. So that's what we're going to do here. Bad debt expense, 7,000. Credit allowance for doubtful accounts, 7,000. That one is easy peasy, right? All right, let's do the next one here. And then I'll go back to our PowerPoint. Now, in this one, in the percent of receivables method, we have to consider the balance in the allowance, right? So in the information, here's what's in the allowance for doubtful accounts. It has a debit balance of $2,500. Now, notice that when we did the net sales method, we didn't need it. Forget it. We don't need this allowance, or we don't need the accounts receivable either. We just needed this. But because in the percent of receivables method, we have to consider the balance in the allowance. So I keep saying that, and you say, well, Tetra, what does that mean? I'm tired of you saying that. It's kind of catchy though, isn't it? The balance in the allowance. Okay. Well, here it is. Assume your company uses the percent of receivables method. Your company estimates that 3% of the accounts receivable are uncollectible. What is the adjusting journal entry to record bad debt expense? Okay, well, what we're going to do I guess we need to show you where we get this information. It's based on accounts receivable. So we're going to use that 230,000 times 3%, right? And so that's 6,900. That's what it needs to be. That's what we need the allowance for doubtful accounts to be, $6,900, right? Okay, now the reason why I said you got to consider the balance in the allowance is that you have a debit balance in the allowance account. So you can't just say, okay, bad debt expense, 6,900. No, because you've got to get, first off, you got to get this debit out. So that's a credit of 2,500. And then you can go another 6,900, and so to get a debit balance of 2,500 to a credit balance of 6,900, you're going to have to put in $9,400. That's how it works there. See what I'm saying? You have to consider that. So how do you get a debit balance of 2,500 to a credit balance of 6,900? Well, you're going to have to credit 9,400, 2,500 just to get it to zero, and then another 6,900 to get it to where you need it to be. So together, 9,400. Now, you might ask yourself, Tetra, why would you ever have a debit balance in the allowance account? Because we know that the allowance account is a contra asset account. So it has a credit balance, just like accumulated depreciation does. Allowance for doubtful accounts has a credit balance. Well, how does it get to a debit? Well, when you wrote them off, that you're going to debit allowance for doubtful accounts during the write-off process. Well, what happens? That's an estimate, and if you underestimate, you're going to be debiting more allowance for doubtful accounts than you have. So sometimes it will make it go as a debit. And if it's a small amount, no problem. But if it gets large, maybe you have to consider, well, I need to adjust my estimate. So I'm pretty close to it, right? So when you get done, before any of the adjustments, hopefully allowance for doubtful accounts will have a zero balance, but that's rarely happens. Okay. So anyway, that's kind of a long thing. But some of you have inquiry minds and say, well, why would that be? Okay. So that's how that works. I'll let you write that down again. Make sure debit, bad debt expense, 9,400, credit, allowance for doubtful accounts, 9,400. And so write this down. Just remember, for the percent of receivables method, you consider the balance in the allowance. Notice here up on the first one, the sales method. For the percentage of sales method, do not consider the balance in the allowance. The only time you need to do this is for the percent of receivables method. Okay. All right. So I'm going to go ahead and stop the share and go back to my PowerPoint here. I think I'm going to give you just a couple more examples. I'm going to do 42. Okay, 2 slides here. So we're in the percentage of receivables method, right? And remember, you have to consider the balance in the allowance. Okay, so let's say that we think that 8% of these receivables are going to go bad. Okay, so we multiply the 8% to the accounts receivable of 72,500. So we believe that of the 72,500, 5,800 are going to be uncollectible. That's the amount that should be in the allowance. In case one, when we go look, hey, There's already $150 in there. There's a balance. We have to consider the balance in the allowance. So we don't need the whole 5,800, right? Because we already have 150 in there. We only need 5,650. Because how do we get a credit balance of 150 up to where it's supposed to be, 5,800? Well, we need 5,650. See what I'm saying? We don't need the full 5,800 because we already have 150 in the allowance account. Now, let's try this second one. It's the same information, right? You've got accounts receivable of 72,500. We think that 8% are going to go bad. And so we want, in our allowance for doubtful accounts, we want a $5,800 balance. Okay. Well, if we look in the allowance account, this time we have a debit balance of 150. That's pretty good. I mean, basically, our estimate was a little bit off. We wrote off more than we estimated, but okay, that's not bad. But anyway, you know, we need 150 just to get it to credit to 150 just to get it to zero. And then we need another 5,800 to get it to 50 to the where it needs to be, 5,800. So basically, how do you get 150 debit to a credit of 5,800? You need 5,950, and that's what we do. Debit, bad debt expense of 5,950, allowance for doubtful accounts 5,950. Okay. All right. Let's stop the share. Go back to the iPad. We're going to now go to notes receivable, and that's how we'll end up. So it's going to be a short session. I'd say probably half an hour, I'll be done, maybe even faster. Okay. Okay. We're going to move on then to problem 6, which is about notes receivable. And we're going to calculate, well, we're going to record the journal entry to that we actually are receiving notes receivable. We have to figure out the maturity date, you know, like when are you going to receive your money back plus the interest, and do some adjusting journal entries and the like. So anyway, let's go through this. Let's say that on December 16, Creative Designs Company makes a $60,000 45-day 12% cash loan to Jerry Smith. We're giving Jerry $60,000. Okay. Now, what's happening is that in 45 days, Jerry's going to give us not only the 60,000, but interest at 12% for the 45 days. That's what that's all about. Don't worry about the 45 days or the percent right now. Let's just record the note. We gave Jerry a loan for 60,000, and we made him sign a note for it. So how do you do that to record the note? Simply debit notes receivable 60,000, and then credit cash 60,000. Okay. Now you may ask yourself, well, it's a 45-day note. So when is that note due? Well, what's 45 days from December 16? Okay. Well, here, this is the best way to do it. First off, you have to know the months of the year and how many days are in it. So I'm going to give you this sophisticated method before we do this to know how many days are in a month. Okay. It's called the Knuckle Method. So basically, if you take your fist and you have a knuckle, And if you land on a knuckle, it's going to be 31 days. If it doesn't, it's not 31. It's probably 30. And of course, in February, it could be 28, or if it's leap year, 29 or something. So, but anyway, it's a good way of knowing it. So let's say, well, how many days are in March? Well, you start here on the knuckle, January, February, March. It ends on a knuckle, 31 days. How about September? Wow, okay, here we go. January, February, March, April, May, June. July is on the knuckle. So then you go back. August, September. So September goes between the knuckles. So we know that September is 30 days. So that's how that works. Okay, so we know that December has 31 days. So what we're going to do is find out how many days the note would be at the end of December. So we're going to go December 31 minus 16, because that's the date of the note. So we got 15 days. Well, to make 45, we need 30 more. Well, if we do that, to get it to 45, that means that on January 30th, that is our maturity date. That is when, that's when the note is due. Okay. Now, when you issue a note, you expect to receive interest. And you probably know what interest is. You might have a savings account and you may get a little interest on your savings account. But what interest really is, it's rent on your money. So you're renting your money to somebody, and for the use of that money, you expect to get paid back the amount that you lent them, plus the rent on the money, which is interest. And this is how we calculate interest. This is the formula. Principal times rate times time. Principal times rate times time. Okay, the principal is how much you lent them. So in this case, you lent them $60,000. The rate is always the annual rate. And remember in the problem, it said, you know, the note is a 12% note. Well, that's the annual rate. Now, what I like to do, because for calculations, I like to convert that percent into a decimal. And the way you do that is just, if it's a percent, you want to do it to a decimal, move that decimal to the left 2 places. So this 12% becomes 0.12. Okay. Now, we're accruing interest at December 31. So, well, how many days do we have to accrue of interest? Well, if it's December 31 and it started on the 16th, right? Well, there's 15 days. And you can see that that's what we did. December 31 minus, of course, December 16 is 15 days. So on December 31, you've incurred, 15 days. So what we're going to do is we're going to do a portion of time. And this is where it gets kind of interesting. You know what? If this was for 6 months, it would just be like half of a year, right? So it'd be 1/2 times this. This is always an annual rate. So what we do, we have to prorate it, and in this case, by days. So, and I know what you're thinking, well, where'd you get that 360? Because if we're going to prorate it as a partial year, it should be 15 divided by 365, right? Because it's a partial year, 15 out of the 365 days. Well, this is when we use 360, that's called a banker's year. In the old days, bankers said, you know what, we have to do this by hand. And they did, they had little calculators, but it was really hard for them. They didn't have computers. They said, it's much easier if we just use 360. It's easier calculation. And so that's what they did. The real reason is because of the denominator, they make more interest. They make more money that way. I think it was deliberate for the bankers to make more money. But anyway, in your homework, you're going to use banker's year. So when you do a partial year, you're going to use 360. So 15 out of the 360 days. So how do you actually use this formula and calculate it? It'd be 60,000 times 0.12 times 15 divided by 360 equals. Now I'll give you your $300. Again, I like this because it's one entry, as you punch it in your hand calculator. 60,000 times 0.12 times 15 divided by 360 equal, and that should come up with the $300. Okay, so now you've accrued interest, so you've earned it, right? That's why you accrue it, but the guy hasn't given it to you. Jerry has not given you it, so it's going to be debit interest receivable of 300 and credit interest revenue of 300. Okay, so let's say it's 15 days. 30 days later, that's going to be the 45 days. In 30 days, he's going to pay us, right? So what's he going to pay us? Well, he's going to pay us the principal plus the interest. Okay, you know what the principal is? That would be 60,000. And so if he pays you 60,000, then he doesn't owe you anymore. So you have to credit his notes receivable. Now, he's also going to pay you what he owed you for that first 15 days, right? So up here, he's going to pay you that interest receivable amount for 300. That's the 15 days. So you're going to reduce what he owes you because he's paying it to you. That's 300. And he also has to pay you the amount of interest for the rest of the life of the note, which is 30 days. Okay, well, and that would be from like January 1 through January 30th. That's 30 days. And so how do you calculate that? Well, it's principal times rate times time. Okay, so we got the principal is 60,000. The rate is 12%. I'll just convert it to a decimal of 12% times a partial year, right? Because if it was 1 year, we just put 1 there and it'd be 12% of this, but it's a partial year, so we've got to prorate it. So it's 30 days, and remember it's banker's year, so it's going to be 30 out of the 360 days. So how do we calculate that? 60,000 times 0.12 times 30 divided by 360 equals, and that would be 600. I'll do it one more time. 60,000 times 0.12 times 30 divided by 360 equals that 600. And so notice that the principal is 60,000 and the interest on the whole note is 900. That's why you have the cash of 60,900. So just remember that when I talk about, the maturity date, well, that's January 30th. If I'm talking about what's the maturity amount, that would be principal plus the interest. Principal of 60,000 and the interest of 900. See that 900, that's interest for 45 days. And we just had to prorate a little bit because we had 15 days in the last period and then 30 days in this period. So it looks a little bit different. Okay, that's how that works. Wow, we're going to get done early. So the last thing I'm going to show you is accounts receivable turnover. And, we want our receivables to turn over. So it gives you an indication of how fast you're collecting your money, right? So the formula is net sales divided by average accounts receivable. Well, net sales is easy, but how would you calculate average accounts receivable? Well, in this problem, they give it to you, right? It's easy. It's just like net sales of 7,200, average accounts receivable of 7 million, put it in. So you know that the accounts receivable turnover is 10.29. But if they didn't give it to you, they weren't nice to you, they made you work for it, you would take the beginning accounts receivable balance plus the ending accounts receivable balance and divide that by 2. And that will give you your average receivable. And then you'd plug it into your formula. So that's how you do it. Okay. So anyway, that does it for me. And so I won't see you again until next week. I'll go over chapter 8 on Tuesday morning. So I'll stop to share. Thanks, folks. See you soon. Bye-bye.